All right, ready to dive in. Today we're tackling something that, I'll admit, might sound a bit intimidating at first glance. Financial performance.
Yeah, it can seem like a whole other language, right?
Definitely. But like any language, once you learn the basics, it's actually pretty fascinating.
It really is. And honestly, super useful too.
No matter what your role is in the business world, or even just as a consumer, think of it like this. Understanding financial performance is like cracking the code to how businesses really work.
Exactly. It gives you this peek behind the curtain to see what's driving their decisions, their successes, and sometimes even their struggles.
And for this deep dive, we're going to be using a really interesting source, a set of revision notes for a GCSE Business Studies course.
Now, I know you're thinking, back to school.
Yeah, no pop quizzes, I promise. But these notes are a great way to break down some of the key concepts in a clear and concise way.
And we're going to pull out the most relevant pieces and see how they apply to the real world.
So think of this as your crash course in business finance, but without the boring lectures.
We'll keep it engaging, I promise.
Absolutely. Now, at the heart of all this is something called financial statements.
Basically, these are reports that businesses use to track their performance and share that information with stakeholders.
It's like a report card for a business, right?
That's a great way to put it. And just like a report card can tell you how a student is doing in different subjects, financial statements can give you insights into different aspects of a company's financial health.
So let's say you're thinking about investing in a company. Checking out their financial statements would be like, I don't know, like kicking the tires before you buy a car.
I like that analogy. You wouldn't just buy a car without looking under the hood, right?
Mm-hmm.
Same goes for a business. You want to make sure everything is running smoothly before you commit.
And just like a car has different parts that work together, financial statements are made up of different reports, each telling a different part of the story.
Exactly. And two of the most important ones are the income statement and the statement of financial position.
Let's start with the income statement. Sometimes it's called the profit and loss statement. What is this one all about?
Well, the income statement shows how much money a business made over a certain period of time. It could be a quarter, a year, whatever period they choose.
So like a snapshot of their earnings.
It's more like a video, actually. It shows the flow of money coming in and going out over that specific time frame.
Okay, so it lays out their revenue, which is all the money they bring in from selling their products or services.
And then it subtracts their expenses, which are all the costs associated with running the business.
So everything from like raw materials to salaries to marketing costs.
Exactly. And the difference between the revenue and expenses, well, that's what we call profit.
So it's basically showing us if a business is making more money than it's spending. Pretty straightforward, right?
In theory, yes. But there's actually a lot more to it than just looking at the bottom line.
Right, because a company could be profitable on paper, but still be in trouble if, like, they have a ton of debt or something.
Exactly. That's why we also need to look at the statement of financial position, which is also known as the balance sheet.
All right, so if the income statement is like a video showing us the flow of money, the statement of financial position is more like a snapshot, right?
You got it. It captures the financial health of a business at a specific point in time.
It tells us what the company owns, what it owes, and what's left over for the owners, which is called equity.
Precisely. And to understand those pieces, let's imagine we're looking at your personal finances. Think about all the things you own that have value.
Like my car, okay, maybe not my vinyl collection. It's more sentimental value than anything.
Oh, maybe for you, but some people have collections worth a fortune. But yeah, those are all assets.
Anything that could potentially be converted into cash is an asset, right?
Pretty much. Now, on the flip side, think about the debts you owe.
Ah, student loans, credit card bills, that kind of thing.
Exactly. Those are your liabilities, the money you owe to others.
Okay, so assets are what you own, liabilities are what you owe, and equity is what's left over after you subtract liabilities from assets.
You got it. So for a business, equity represents the value that belongs to the owners or the shareholders.
And if a company has a lot of assets and very few liabilities, that means they have high equity.
Right. And generally, that's a good sign. It means they're in a strong financial position.
This is starting to make sense, but I'm still a bit fuzzy on how we actually use these statements to evaluate a company's performance.
Well, that's where the real fun begins. We can use these numbers to calculate what are called key performance ratios.
Okay, ratios. Sounds like we're about to get into some math.
Don't worry, it's not as scary as it sounds.
As long as you promise to walk me through it.
Absolutely. And I think you'll be surprised by how much these ratios can reveal about a company's inner workings.
All right, I'm ready to put on my analytical hat and see what these ratios can unlock.
Let's kick things off with a ratio that's super easy to understand. Gross profit margin. Now remember, gross profit is what's left over after a company covers the direct costs of, well, making a product or delivering a service.
Right, right, like those lemons and sugar in cups for our lemonade stand from earlier.
Exactly. So the gross profit margin tells us what percentage of each dollar of revenue actually ends up as gross profit. So if a company sells something for, let's say, $100 and their gross profit is $50, their gross profit margin would be 50%.
Okay, so higher is better, right? A higher gross profit margin generally means they're keeping more of their revenue. But what's that really telling us about the company? Beyond just like being efficient with their costs?
It can actually reveal quite a bit. A high gross profit margin might mean they have a super strong brand, which allows them to, charge a premium for their products. Or it could mean they've got some really sweet deals with their suppliers, giving them a competitive edge.
Interesting. So it's not just about keeping costs low, it's about having the power to command higher prices. Okay, that makes sense. Now, what about net profit margin? How is that different?
So net profit margin takes a wider view. We're looking at all the expenses a business has, not just the direct costs. So things like rent, salaries, marketing, research and development, all those operational costs that keep the lights on.
So this is kind of like the real bottom line, right? After everything is paid for, what percentage of every dollar earned is actually profit?
Exactly. And this is where things get really interesting. A healthy net profit margin tells us the company isn't just good at making or selling their product, they're good at managing their entire business.
So it's a good indicator of whether they're going to be around for the long haul.
Absolutely. It shows they can consistently turn revenue into actual profit, which at the end of the day is what drives growth and creates value for investors.
Man, this is making me want to go back and look at some companies I'm interested in, see what their margins look like. But before I get lost in a rabbit hole of financial statements, let's talk about a specific example. You mentioned BrewBliss earlier, right? Can we use their numbers to illustrate these ratios?
Yeah, let's do it. So based on the information we have, BrewBliss brought in 80,000 pounds in revenue. Their cost of sales, which includes all those direct costs of, brewing and packaging their beverages, was 40,000 pounds.
All right, so to find their gross profit, we just subtract the cost of sales from the revenue. So 80,000 pounds minus 40,000 pounds leaves us with a gross profit of 40,000 pounds.
You got it. Now, to get that gross profit margin, we divide that gross profit, the 40,000 pounds, by the total revenue, which is 80,000 pounds, and then multiply by 100 to express it as a percentage.
Okay, let me see. That gives us a gross profit margin of 50%. Wow, that's pretty impressive. They're doing a really good job of managing those production costs.
They are. But remember, we can't forget about those other expenses. BrewBliss also had operating expenses of 25,000 pounds, which includes things like rent for their brewery, salaries for their employees, marketing campaigns, that sort of thing.
Right, so to figure out their net profit, we got to subtract those operating expenses from the gross profit. So 40,000 pounds minus 25,000 pounds gives us a net profit of 15,000 pounds.
Perfect. Now, for that net profit margin, we divide that net profit by the revenue and then multiply by 100, just like we did before.
15,000 pounds divided by 80,000 pounds multiplied by 100. That gives us a net profit margin of 18.75%.
You're a natural at this. Now, 18.75% might seem a bit lower compared to that 50% gross profit margin, but it's still a pretty healthy number. What do you think this tells us about BrewBliss, like their overall financial health?
Well, it seems to me that they're not just good at making their products, they're good at managing their business as a whole. They're turning a good chunk of their revenue into actual profit.
Exactly. And that's a key takeaway here. Both gross profit margin and net profit margin are important, but they tell us different things. Gross profit margin is all about the efficiency of production, while net profit margin is looking at the bigger picture, the overall business management.
This is so cool. It's like these simple ratios can unlock so much information about a company. But wouldn't different people interpret these numbers differently depending on their, I don't know, their perspective, their role?
That's a great point. Let's think about who might be looking at these numbers and what they'd be looking for.
Well, investors would definitely be interested, right? What would catch their eye?
Investors, they're always going to be looking at profitability, both those margins we talked about, gross and net. They want to see that a company can consistently make a profit and grow their earnings over time. But they're also going to be looking at other factors, like the company's debt levels, their cash flow, and their potential for growth. The whole package, basically.
Makes sense. Now, what about creditors? They're the ones lending money to the company, so they must be pretty interested in these financial statements too, right?
Oh, absolutely. Creditors are laser focused on a company's ability to, pay back their debts. They're going to be scrutinizing that balance sheet to see what the company's assets and liabilities look like. Basically, they're looking for signs of financial stability and liquidity.
Liquidity, what exactly does that mean?
Liquidity basically means, can the company meet their short-term financial obligations? Can they pay their bills when they're due? Creditors want to make sure the company's got enough cash on hand or assets that can be easily converted to cash to cover those debts.
Okay, so creditors are all about making sure they get their money back. That makes sense. Now, how about employees? How would they view these financial statements?
Well, for employees, the company's financial health is directly tied to their own job security, right? And their potential for, I don't know, raises, promotions, things like that. They'd obviously be interested in the company's profitability, but they might also be looking at things like revenue growth, which could, signal expansion and new opportunities. Maybe even how the company invests in its workforce, things like training programs, benefits, and of course, salary increases.
So it's like everyone's looking at the same set of numbers, but they're focusing on different details depending on what matters most to them. It's amazing how much information you can get from these financial statements.
There really is. And it shows why understanding financial performance is so important, no matter what your role is in the business world.
I feel so much more equipped to navigate this whole world of finance now. It's like a whole new language has opened up. But before we wrap up, is there anything else we should touch on in terms of like analyzing financial performance?
Yeah, it really is a lot like a puzzle, right? Every piece adds a new layer of understanding.
And speaking of putting the pieces together, how about a quick recap before we wrap up? We started by diving into the income statement, which shows us a company's profitability over a period of time.
Right, and we saw that revenue minus expenses equals profit. Pretty basic, but such a fundamental equation for understanding how much money a business is actually making.
Then we move on to the statement of financial position. Gives us a snapshot of what a company owns, what they owe, and what's left over for the owners.
And we broke down those key terms: assets, liabilities, and equity.
Showed us how those elements can tell us a lot about the overall financial health of a company.
And then we got to play with ratios.
My favorite part.
We saw how those gross and net profit margins can be really insightful, giving us clues about a company's efficiency, pricing power, and how well they're managing their expenses.
And we didn't just stop at the numbers themselves. We talked about like how different stakeholders might interpret those numbers differently.
Right, because investors, creditors, and employees, they're all looking at the same information, but they're going to focus on different aspects depending on their own priorities and interests.
It's amazing how much information you can get from these financial statements once you know how to read them.
Absolutely. And it's not rocket science either. With a little bit of effort, anyone can learn to understand these concepts.
It's like we've been given this secret decoder ring. Now we can, I don't know, unlock the financial secrets of any business that piques our interest.
The possibilities are endless. So many fascinating companies out there, each with their own unique financial story.
This has been such a fun journey, and I feel so much more equipped to like navigate the world of business and finance now.
It's been a pleasure sharing this deep dive with you. And remember, this is really just the beginning of your exploration.
There's always more to learn.
Exactly. And the more you understand about financial performance, the better prepared you'll be to understand the sometimes confusing world of business.
Well said. So, to all our fellow deep divers out there, stay curious, keep those questions coming, and never stop exploring.
Until next time,
Happy analyzing.
topic